Coming a day after stocks suffered their biggest market drop in more than 8 years. Joining me right now, Silvercrest Asset Management Chief Strategist, Patrick Chovanec. Patrick, it's good to have you on the show. Thanks so much for joining us.
Great to be with you.
Would you put new money to work in China right now?
I think you better be really cautious about it. First of all, there's a difference between what's going on in Hong Kong and what's going on the mainland. Mainland had a much bigger bubble. Hong Kong had kind of a mini bubble starting in April to catch up with what was taking place in the mainland, but a lot of those gains have already been erased. So Hong Kong's back to more reasonable valuations. It's affected a lot by the volatility that's taking place in China, and you got to be aware of that. But I think the key here is that China is going through a fundamental economic adjustment, and that's going to create winners and losers. And so what you want to do is not be distracted by kind of the overall indices, but you want to focus on who are the winners and losers that are going to be created by those more enduring economic changes that are taking place in China.
Let's talk about that, because Anastasia, Amoroso, they are looking at a whole massive transition going from a export-led economy in China to a consumer-led economy. But when you look at the most recent run-up, before we had all this volatility and sell-offs in Chinese stocks, the fundamentals weren't there in terms of the backdrop as a reason to own stocks in China.
It's exactly right, because if you look at China, if you look at the mainland shares, this is probably the greatest divergence between market performance and economic performance that we have seen. If you look at economic performance since October, not much has changed. The Chinese data did not improve that much, or actually, if we believe last Friday's PMI number, it actually declined over the course of the last month. And yet the stock market, even with the recent pullback, is up about 80%. So there's a huge divergence going on there. So I think my point would be is that the time when we see the floor put into the stock market is when the Chinese government's economic measures start to work. Because they can try to stop the selling, they can try to induce the buying, but that's limited in nature, it's limited in scope. So it's only when the economic measures have kicked in and we actually see a turn up in the data, that's when I think we see the floor in that market.
You see a floor when all of these government measures to prop up the market, that they get rid of them. You've got sellers on the sidelines that want to sell, but you have, like, the Wall Street Journal commissioned this report in a point in the middle of July. 97% of all listed companies' shares were not trading. More than half because of management, because they sought a suspension, and then 46% because the share prices were down the daily limit of 10%. So you've got sellers sitting by, and until everybody gets out of the way, you're not going to find that bottom.
That's exactly the problem, though. I think you still have a rally that's 80%. So you have a lot of people that are wanting to get out while they can, meaning when there is this government support. Because eventually, if that support is pulled and you've not sold your shares, that's a problem. So I think there is a first mover's advantage, and that's what we're exhausting right now, is that selling pressure.
Does it have a broader impact on the way you allocate capital globally? I mean, looking elsewhere, U.S., Europe.
Of course. China is the second largest economy in the world. But I think that you've got it, when you talk about contagion, and people are concerned about contagion right now, I would put them into two different categories. The first is things that are directly affected by China's economic story. Iron ore, copper, other commodities, the Australian dollar. Those things, it makes sense for there to be contagion because they're connected with the underlying story. There's a broader contagion, which is people all of a sudden, they were focused on Greece, now all of a sudden they're paying attention to China, and they say, whoa, what's going on? This can't be good. It's going to take people some time to wrap their minds around this change. Who are the winners and losers? What the actual impact's going to be? I think that I would not buy into that knee-jerk reaction of saying, oh, okay, China's going to drag us all down, because China's economic adjustment, while very tumultuous and very disruptive, is actually something that is important for China to go through. We need China to go through this process, and actually it's going to help the global economy in the long run for all this overcapacity, this build out of overcapacity that's been driving Chinese growth, for that to be reined in.
So real quick, how do you allocate capital right now? Do you like the U.S. market?
U.S. is stretched a bit. Right now we're at 19 times earnings, and I think that's the reason. And earnings have been relatively flat year on year, which is why we're not really seeing that much growth in prices. Japan is an interesting story right now because some of the real reforms are kicking in. TPP, the Trans-Pacific Partnership, is going to be a vehicle for a lot of reforms that need to take place in the Chinese economy. Finally, that's going through. In the Japanese economy, finally, that's going through. So I think that there's some promise there. But right now, I think you've got to be selective within markets and diversified among markets, because a lot of markets are fairly richly priced. So you got to be careful. Richly priced, and in the middle of earnings season, it looks like we have another miss in terms of revenue coming from DuPont. Patrick, good to have you on the show today. Thank you so much for joining us. Thank you. Patrick Chovanec joining us, Silvercrest Asset Management Chief Strategist. Anastasia, got to get your take on earnings as well. We're